The 5 hidden powers of the Roth IRA not discussed much, like the 85% Social Security benefits ghost tax, how to increase your net cash flows or incomes with other investments using this Roth IRA tactic, and especially if you are married, have a spouse, have a partner, if you have a child or children or anyone that you love and you want to protect while both alive and when passing with your legacy when you're gone, then this is going to be for you. And even more so if you want to retire earlier, wealthier, and happier, these 5 hidden Roth IRAs not discussed much are needed for you. Now, you're going to hear what I'm saying here from real stories, to real people, using examples, several visuals here throughout as well. My name is David Lundberg. I'm a fiduciary financial planner and tax strategist for over 10 years now. I do have a double master's degree, and I am the owner of Awaken Financial Designs. And I have taught these topics here to thousands of people over the years, and I continue to use in classes here as well that I want to share them with you to help you out in your own situation. Now, this isn't going to be your typical Roth IRA that you hear from so many people out there. These aren't going to be anything hidden or secret. They're just not discussed a whole lot. They have big, meaningful value. And the whole point of this is to protect the ones you love while you're alive and when you pass, and to leave a lasting legacy and have tax-saving strategies in addition to all this as well. Now, I kindly ask you here to like this video here, to comment on here, or to subscribe so I can continue helping out so many people out there as well. And if you find value, please share it here as well, that we can help out other people with their future. Now, there will be different sections here throughout with, again, tax charts, visuals, and explanations. But here at Awaken Financial Designs, in our own thing, we're very about spiritual and having money just be one tool of many that is out there to create a holistic well-being. That's why before we go to these 5 main topics, remember, it's not just powerful tax strategies, it's a vessel of peace, protection, and lasting legacy of love. Now, if you don't care about protecting your money, you don't want to have savings on taxes or protection on taxes, you don't want to protect your spouse or that loved one when you're alive and or when you pass, this video is probably not going to be for you. Now, you've worked so hard, or you're still working for all the money you have and what you have invested, but let's find a way to have that money be smarter. That way you could find time to retire earlier, wealthier, and or happier. And let's look at these various tax impacts that oftentimes are too late that we can help you out with, be proactive on here. And it's also helping out with that financial piece. You know, financial stress is a leading cause of stress, and stress is the leading cause of disease and illness. So if we can help you out with financial stress and decrease it with these 5 topics, let's do that. Let's go ahead and get into our first topic here, which is the Social Security benefits tax and the protections you could utilize or have. Now, in all the years that I've been doing this, I've taught and explained to so many people that had no idea, even in classes just last week, and I have a class coming up here next month as well, that the IRS utilizes a formula for determining what amount of your Social Security benefits can be taxable. Now, let's take a look at this chart here coming on the screen to see what I'm referring to. Now, the IRS here will look at this tax formula, and they're going to determine what can count against you for reducing your benefit amount. Now, you'll notice on here, Roth IRAs are not on here, so Roth IRAs don't count against you. However, 401k, an IRA, a TSP, your W-2 income, even the required minimum distributions, and even half of the benefit amount you receive also counts against you, all to determine if you're going to be taxed on that benefit amount. Now, on this next visual we can see on here, on the left-hand side, this is for an individual tax filer. On the right-hand side, this is for married filing jointly. Now, these again are for determining what amount of your Social Security benefits could be taxed. Could be 0%, 50%, or 85% of the benefit amount you could be added as taxable income. So it's not an 85% tax. It means 85% of that benefit amount could be added to your taxable income for that year. And then if you're in, say, a 24% tax bracket as an example, then you'd have a 24% tax potentially on 85% of that benefit amount. Now, also we could see as examples on the top right hand here, the IRS does have a actual formula or guideline showing you on here. Now, take for example, if you're married filing jointly, more than $44,000 in combined income, using that prior visual on here, then 85% of the benefit amount is added as your taxable income. But again, the Roth IRA does not count against you. And the Roth IRA, you could have $50,000, you could have $100,000. Doesn't count against the benefit amount, so you still could get your entire benefit amount without that being taxable using the Roth IRA as one example. Now, let's go on here to the second topic, having that spouse and that loved one. Now, I personally have seen it over the years. Unfortunately, when someone is married and someone does pass away, could be in their 40s, could be in their 60s, or even in their early 70s on here, just happened last week to someone else, is that when they're married or together, as you can see in this chart coming up here, there is a married filing jointly tax status. And as you can tell, the income amounts are much higher than the single tax status on here. However, as you can see in this chart, when someone passes away, they now go from the married filing jointly tax bracket to the single filing jointly tax bracket, which means that the income amounts they had prior could be taxed more. Here's an example on this chart. Let's say they had $100,000 in net after-tax money for annual cash flows while they're married or they're both alive. One spouse passes away, that surviving spouse now still has that $100,000 they want to have in net cash flow. However, because they're in a single tax bracket, they are now taxed more. So now they have to take out more money from their investment accounts to still net that same $100,000. Now, again, I've seen this happen quite often on here, but we could be proactive on here. And instead of having all your money or too much money in IRAs, 401ks, TSPs, and more, we can have more money in that Roth IRA account. So now that that money's in that Roth IRA account, when someone does pass away, say spouse one has a Roth IRA of $2 million, they pass away, that surviving spouse gets an inherited Roth IRA. So even though they're now in that single tax status, it's still a Roth IRA, it's inherited, that's tax-free money. So that surviving spouse doesn't have to worry about extra taxes. They could still take out that net $100,000 cash flow without worrying about taking out more money. So again, that Roth IRA is very powerful for that surviving spouse who's left on there an inherited IRA. Now let's go on to the next one here is topic 3. Your child and or your children. You know, I myself have 2 kids. I've known other clients of mine and friends of mine and even other clients with their advisors that had kid or kids as well. And kind of similar concept, last thing on there, but when you pass away, if you give your IRA or 401k or TSP to your child or children, they get an inherited IRA. Now keep in mind, like on that tax chart, they are still going to be taxed at their ordinary income level. So it's still taxed regardless, even though it's an inherited IRA. Now, if that child or children are still working and they have to take money out of that inherited IRA account, their tax could be much higher. Or maybe they themselves have a high IRA or TSP or a tax-deferred account. They now get your inherited one on there, and those taxes can still be higher. However, if you have a Roth IRA, when you pass away, that child or those children, they get a inherited Roth IRA. So now if they are working, even if they're in a high tax bracket themselves, that inherited Roth IRA is tax-free to them. So that inherited Roth IRA can leave a lasting legacy to your child or children here as well. Let's go to number 4. Now, in prior videos, I've gone quite deeply on here on IRA to Roth IRA conversions. It's a pretty hot topic I talk about in my classes here monthly all the time as well, with very deep analysis into this. But look at this visual here on here, right? People are always wondering, I have an IRA or a 401k. How much should I convert to that Roth IRA? Well, there is no easy answer, right? You have to take into account so many things from your age to your gender, married, single, retirement, tax impacts, tax brackets, and so much more. So we always analyze and do factuals. We don't just guess around here. So that's what our team does specialize in, to find out what are the current tax impacts, how much could we convert each year, what's the tax impact, potentially what's the tax break-even point in the future, how could this impact my surviving spouse, my child, my children, what tax protections can it give me, how could it save me and let me keep more Social Security benefits, and so much more. So if you have those large IRAs or 401ks, if you think about doing a conversion to a Roth IRA, don't just guess. Make sure you do a deep analysis first on there. And if you're even younger, in your 30s or 40s, maybe you are working in that 24% bracket or 28% bracket or whatever it might be, doing some conversions now over time could allow you to have a greater tax benefit in the future here potentially as well. Now, let's go on to the 5th one on here. How can we increase our net cash flows or our net incomes and have lower taxes? Well, keep in mind the Roth IRA money, that is going to be tax-free with qualified criteria withdrawals that are met. So with that Roth IRA money that is taken out, that is tax-free because you met that qualified criteria, you could take out $100,000, you could take out $1 million, you could take out $10 million. There's no tax on that Roth IRA money. Now, the other money we have on there, using this chart, it's going to come up here as well. Now on this chart, we're going to see long-term capital gains. We're also going to see ordinary income tax on this chart too. Now keep in mind in that non-qualified, non-retirement account, using the chart on the left here for long-term capital gains, as an example, if you're married filing jointly, we could take out up to about $96,000 in long-term capital gain money, plus additional money from the Roth IRA because Roth IRA money is tax-free. Another example using the same chart here is on the right-hand side now, the ordinary income one. So your 401k money and your IRA money or TSP, when that's withdrawn, that does get taxed as ordinary income, as you can see on the right here. Now, if we're married filing jointly on there, we could see roughly in that 12% tax bracket, we can go up to about $96,000 with that 12% tax on there. Now, that would also impact your Social Security benefits because IRA money and 401k money can count against you, as I saw in that prior formula. But Roth IRA money could be additional because that Roth IRA money, again, is tax-free. Now, tax planning is always crucial, and it's one of the first components of our own firm here that we look at. In the end, right, it's about protecting your money. It's about the net, what you get to keep, what you get to spend, how to protect that spouse, and how to protect that child or those children for whenever you do pass away on here. So if you want help on these topics, if you want to learn more on these topics, you can always comment below on here. You can reach out to us at awakenfinancialdesigns.com here as well. And always remember too, how can you retire earlier? Well, you want to retire earlier. The Roth IRA account could be one of the best tools that tax protections it could provide and that tax certainty throughout the future that it does allow on there. So again, if you want to find out more about it here, how you can have a lasting legacy, a legacy of peace while alive, a legacy of peace when you pass away, and you have those large IRAs, 401ks, those tax-deferred accounts, and you might be considering doing a Roth conversion, you might be considering those Roth IRA potential impacts on there, feel free to reach out to us. We're happy to build a roadmap with you as always. Educational only, not financial, tax, or legal advice. Thank you so much for being here today. Look forward to talking to you.